And I thought, who better to have on to talk about this stuff than one of the biggest proponents of neutral strategies and just the understanding of how to get them done in the derivatives space, because you've done a lot of work, Mr. Butler, with calls and puts and creating neutral strategies with options. And we've got here just the S&P 500, probably the most, and you can correct me if I'm wrong, but in my mind, this is like the flagship strategy of Tasty Trade. And maybe you can explain it a little bit to people, what this short strangle is and what, in essence, it's getting done in the market. Like if you were to sell this strangle and sell a put and call option, what you want to happen and what you profit from by doing so.
Yeah. So with the short strangle, you are ultimately selling an out of the money put and selling an out of the money call at the same time. And I think the easiest way to think about selling options to open is simply that you're betting against a movement in a stock price. So with the S&P, maybe you're going 10, 20 points out of the money on either side. You're creating a 40-point range for the product to move. And it's neutral because these options offset each other directionally, and you can benefit if the stock moves up slightly, moves down slightly. That's kind of the best case scenario, is when you get this kind of choppy back and forth action. And it benefits from the passage of time too, because you're selling extrinsic value premium with these out of the money options. And as long as the clock keeps ticking, which hopefully we can keep counting on happening, you're going to have this extrinsic value decay, which helps, again, offset directional moves against you. Even if the stock reaches one of your strikes or gets pretty close, as long as you're closer to expiration, it's going to have a lower value than what it did up front. But I do like the idea of selling premium in these products, especially if you're looking at strangles, using products like SPY or the Qs, something that's more of a basket of stocks than these single name equities that can go crazy. I think, it's a great strategy for people that are neutral or want to create a neutral assumption and have the capital available to have undefined risk.
Great explanation there. The part that I loved the most was that you didn't fully assume that time was linear. You're like, as long as time continues, which like hopefully it does, there's an outside chance that time stops and the linearity of time is disrupted. But as long as time continues to tick away, you get paid from this market just not moving up a bunch and not moving down a bunch. And it's really this is true empowerment for the everyday person, the retail trader, whatever you want to call yourself, to not have to pick a stock or pick something and be hit with a 50-50 proposal of like, well, I had to do a bunch of research and I hope I'm right. This is a strategy that's usually, 60%, 70%, 80%, even as much as 90 to 95% probability of you profiting. And the best part is like, I don't need to stick my neck out and be like, I profit if it goes up or I profit if it goes lower. It is that neutral idea that I think is truly empowering for a lot of people. And hopefully we can lend to futures. But here is the thing, is if time continues, Mikey, and we don't see any movement and I just take my money and I go home, that's awesome. That's the best case scenario. But inevitably, you're going to sell this strangle and maybe you do it a few times in a row and you don't get challenged or tested, as they say in the industry here, on your call or your put. But inevitably, the market is going to move higher or lower during your trade. But what's really nice about this, and I think, we almost take it for granted, you and I, because we've been doing this for so long, is the market moves higher and I get short. The market moves lower and I get long. And it's almost like, yeah, that's what I would have wanted anyways, right? Like it's a pretty cool idea that you start out neutral. And if the market has an outlier rally or an outlier sell-off, you're getting on the other side of it. And it's like, yeah, I would have wanted to be short the S&P above the highs, or I would have wanted to be long when it's crashing, right? Like that makes sense.
Yeah, it gives us the ability to kind of naturally develop, or the trade will develop into, like you're saying, sort of this contrarian stance. And again, if you have the capital to deploy this, you could roll this thing forever. And we've done many, we call it anatomy of a trade on Tasty Trade, where we've shown, I've been in a trade for 6-7 months and I'm just rolling forever and collecting so much extrinsic value premium that now it really doesn't matter where the stock goes as long as it stays, within this range. And the best example I have is DraftKings. We started this idea to just have a trade on for the entire year, and we chose DraftKings because of its high IV. And we started with $5 in premium, and now I have almost $3,200 in premium on a $50 stock. So it's like, it doesn't matter where the stock goes now. It's just like a matter of when I take this off. As long as it doesn't, double in price or get cut by 50%, we're going to be okay.
That's really an awesome example, and really is an ode to the neutral strategy and how much it's done for the everyday trader in the last handful of years. And it's so cool that I wanted to try to lend it to futures, because you don't have calls and puts in futures. If anything, futures are kind of viewed by the options trader as kind of archaic, like almost like I don't want to use this word, but like almost like Philistine. It's like, oh, futures, there's no theta, there's no gamma, there's none of this stuff. Why are you even doing that? But they do have, first of all, they have a ton of great advantages: the cost efficiency, the leverage you get with futures, and the ease with which you can buy and sell and day trade. And you don't have to worry about day trading rules and all that different stuff. I don't even want to get into it, but you can actually commit some neutral strategies to this. And I know you've talked about this with Katie and a bunch of our other friends here on the network. It's a very similar idea, Mikey, where it's like, futures are different than stock options and ETF options in that, like, you get great access to every asset class. And so on your board, you don't have necessarily DraftKings and Apple and everything like that, but you've got like 4 or 5 stock indexes. You've got a handful of commodities. You've got a handful of foreign exchange. You've got a handful of interest rates. And now here in 2021, thanks to us and a few other exchanges, you've got a handful of cryptocurrencies like Bitcoin. And so on any given day, Mikey, a market is busting out to the upside or the downside, and you can use futures to do what that short strangle does organically, which is look at the ranges here via volatility, which is the same as options. That implied volatility kind of puts you at your call and put strikes. And on any given day, you're going to see an outlier move. We've got it today in cryptocurrencies to the upside. And then also, I think natural gas is falling lower here. So and also crude oil is ripping to the upside as well. So any given day, you've got a market that's outside its range, but it's the idea of just like, and this is what scalping is and day trading is, the idea, Mikey, of taking that contrarian viewpoint just straight to the market, but waiting for it to get up above where your call strike would have been or down below where your put strike would have been, and then selling the future up there or buying the future down here and looking for a short-term scalp. I mean, it's the same volatility. It's the same, you see this projected window in the same way that you project the window in S&Ps. It's just a matter of, on any given day, perusing all the markets and being like, that one's got an outlier move. That one's going to outlier move. I'm going to go to the futures and commit a contrarian scalp. Is this making sense?
Yeah, 100%. And I think this is super powerful with the smalls products because you get that big leverage. And regardless of whether you're trading crypto or some of the metals products or the SM75, and let's say you're selling strangles in some of the products in the SM75, and you start to see the market kind of fluttering around here, or you see that all these dips are just being bought immediately. Maybe you're like, well, I want to protect myself a little bit. I'm going to go and buy some SM75 contracts against maybe some of these individual positions I'm trading. And now you're combining the ability to get long delta in SM75 with that theta decay component with the strangle like we're talking about. So you can structure these strategies and build more of a neutral stance, especially if you start to get tested on the call side, let's say in the strangle, you can go out and buy the SM75 products. So if we continue to go to the moon, our new favorite term, you're going to be hedged, and you can hedge yourself and hedge some of that risk to the upside that you might have.
A great call there. I'm glad that you brought that up. I mean, I got an email as recently as this morning with someone who's like, if I've got some short premium in market X, what can I do to lighten that up when the market moves through my call or through my put? And small futures, and also I have to say it, micros from the CME have done such great work to help hedge those deltas. Because say you have, a short strangle in CL, the big crude oil futures there. And now your call strike is obviously being tested. The market's at new highs since 2014. I can go to the small crude oil, which is a tenth the size, and buy one of those. And then immediately I've cut 10 deltas out of my strategy, which is real. And then guess what? If the market backs off and now I'm getting closer to neutral, I just take that future off and my hedge is done. It's really, really easy, especially when you have smaller futures like those from the small exchange that aren't going to overwhelm the position. Because it used to be, Mikey, and you know this, like, oh, I've got a short strangle in CL. The market moved to my call. What am I going to do? Buy a CL contract? Now I'm long. It's too big. And now you've got this flexibility. But then also, just like our buddy Errol did just today, you can, with no positions on, you can wait until you see a big move higher in crude oil, or like we're seeing a big move higher in crypto, and just put that short futures contract there above the expected range, get hit, and then bank on the fact that probability is in your favor and that market hopefully will come back a little bit, and just get in and out of the futures for a profit in its own right. So great segment here. I'm glad that we covered the hedgeability that you have with futures, but also just from a strategic standpoint, starting out with just a futures position to scalp a move outside of the big range here that you're given from volatility. An awesome program here, Mikey. Thanks so much for joining me to talk about futures trading with neutral strategies. Hopefully that went well, right? That wasn't too painful, was it?
It was a breeze. It was great. Loved it.
Awesome, man. I'm glad to hear it, because honestly, in this, I'll lift the curtain a little bit. Like, as the guy who's like the small stakes guy, I have to, when we refresh the show, I was like, let's get some new talent on here, some new faces, some new viewpoints. But it always stinks to be like, hey, Mikey, can you help me out on Mondays and like give me 30 minutes of your time? So I'm glad that you're enjoying it. I know everybody at home is enjoying having you on, because you give such a great, unique viewpoint here at the Tasty Trade Network, Mikey. So thanks a million for joining us.
Yeah, absolutely. And I think that's a great point. I mean, when you have a bunch of different people, and that's like a question, like, if I'm doing this, like if I'm selling premium, how much can I expect to make in a year? It's like, well, I can't tell you that, because I don't know what you're trading. I don't know what your strategies are. And it's like, it's refreshing to get someone's viewpoint that might be different than yours. And then you're like, oh, maybe I can start deploying that. Or maybe it's like, oh, you know what, I'm not interested in that. But either way, at least you get that additional viewpoint and more opportunities. More opinions in the market is just going to give you more potential opportunities. So I love it.
Exactly right. Well, thank you for giving us your unique viewpoint. He'll be on here every Monday with us, Small Stakes Show, 12 o'clock Central. Don't miss it, everybody. And also don't miss Splash into Futures, which is coming up next. I'm going to be joined by Peter Molmat, and we're going to jump into the platform and trade some futures around. It's a weird Monday. Given like it's kind of a bank holiday, so treasuries are a little wonky, but there's plenty of stuff to do. So Peter and I will get some stuff done. Hang out for that. Thanks, Mikey, for joining us, and thanks everybody for watching Small Stakes. We'll see you next time.
See ya.